The real reason the stock market is crashing right now isn't one thing, and it isn't what most people are telling you. And if you give me the next 15 minutes, I'm going to walk you through the whole picture. But before we dive in, the only thing I ask in return for all the work that goes into making a video like this is that you hit that like button and don't forget to subscribe. Because every time you do that, YouTube pushes this video out to more people, and that helps us prepare more people for what is actually happening. The United States is currently carrying more than $38 trillion in debt, and by every historical precedent, the current system should already be under extreme stress, and yet the country keeps operating as if nothing is wrong. Financial markets keep hitting all-time highs while the real economy is deteriorating underneath, and the people who come out ahead are the ones who understand why. By the time we're done, I'm going to point you toward one specific corner of this market that's quietly setting up as one of the most compelling buying opportunities I've seen in years. A company with a deep pipeline, a reliable dividend, and a business model that doesn't care whether ChatGPT can write your emails or whether ServiceNow survives the next 5 years. In times like these, that kind of company is exactly what rewards patient investors. So keep that in the back of your mind and we'll come back to it. Now, the surface story everyone's telling you is simple enough. The stock market just had one of its worst days of 2026. Gold is surging, investors are panicking, and the two headlines everyone's pointing at are tariffs and AI. But if you think the chaos this week started on Friday when the Supreme Court struck down Trump's tariffs, or on Sunday when a financial research firm published a piece on AI risk that moved markets by Monday morning, you're looking at symptoms and not the disease. Let me take you back a little further because to understand what broke this week, you need to understand what was already broken. President Trump came into office with a bold trade strategy. Use tariffs as leverage, a blunt instrument to force renegotiation of deals with China, the EU, Japan, Britain, and others. Tariffs as a negotiating tool is not a crazy idea. Companies use leverage, that's how geopolitics works, but here's where it unraveled. The administration relied almost entirely on something called IEEPA, the International Emergency Economic Powers Act, arguing that trade deficits and the flow of fentanyl from China constituted a national security emergency, giving the president unilateral authority to impose sweeping tariffs without going through Congress. The Supreme Court said no. The court ruled that IEEPA was designed for genuine extraordinary threats, not long-standing trade agreements that have been in place for decades. Justice Gorsuch wrote a remarkable opinion laying out a civics lesson for our era about separation of powers, about how our founding fathers intended the branches of government to work together to reach consensus because meaningful, lasting change requires broad buy-in. And here's the part that really gets me. The administration had strong majorities in both houses of Congress. And if you want tariffs that last, tariffs that withstand a legal challenge, tariffs with real teeth, you write a law, you put the president's authority explicitly in statute, and the Supreme Court has to follow. Instead, the administration charged cavalry with swords raised, you could say, straight into a defensive line armed with constitutional law. And I keep thinking about those World War I videos where French cavalry charges into German lines on horseback with their swords drawn because they're fighting the last war, and the German soldiers behind their machine guns just cut them down. You had the majorities, you had the moment, and instead of locking it in permanently, you rushed in and left your flank completely unprotected. And now we're scrambling. That's a weird analogy, but it's more than $130 billion in tariff revenues collected, now potentially subject to refund. And here's the bitter irony. Consumers paid higher prices, but the refunds go back to the companies, not to the people who absorbed the cost at the register. So you paid more for your tires, the refund doesn't come back to you. The administration is now reaching for Section 122 of the Trade Act of 1974, a provision that limits tariff imposition to 150 days. It started at 10% before being revised upward to 15% within 24 hours, and the plan changed overnight. Markets always noticed when the plan changed overnight. Meanwhile, the EU said, we negotiated with you when those tariffs were the backdrop. The leverage is gone. Why should we honor our commitments when you can't enforce yours? And they've suspended implementation of the trade deal entirely. So we've gone from a sweeping tariff regime to the tariffs being struck down to a 10% global tariff to 15%, to trade partners walking away to a 150-day emergency measure expiring in July, right in the middle of midterm season with no clear path forward. Companies are making long-term capital allocation decisions. Do I build this factory in Mexico? Do I sign this 10-year supplier agreement? They cannot answer those questions right now. And when companies cannot answer those questions, they freeze. And when they freeze, investment slows. Hiring slows. Economic growth slows. We're back to square one on trade. Now, if you're thinking about how to position your portfolio through all this, I put together a list of the best 6 stocks to own in 2026 that you can download completely free at free.stockscommunity.com. That link is in the description. I think the website's up right now. And at times like these, when the real economy is deteriorating while markets stay elevated, maintaining a balanced portfolio that can ride through the chaos is exactly the right move to maintain. But let's keep going, because the tariff story is only half of what happened this week. Over the weekend, a financial research firm published the most talked about piece in markets in months. And the thesis went like this: agentic AI is getting so good so fast that we may be heading into a scenario where businesses massively cut white collar labor costs, jobs. GDP looks great on paper, but doesn't circulate in the real economy. And this negative feedback loop emerges where companies lay off workers, workers spend less, consumer demand weakens, companies invest more in AI to protect margins, repeat. And they call it ghost GDP in this report, economic output that shows up in the official numbers but doesn't translate into real quality of life. So the piece was explicitly speculative and assigned a low probability to the worst case. But the market didn't react to the probability, it reacted to the concept. Software stocks got hit hard. ServiceNow down almost 4.5%. Salesforce, Monday.com, payment companies, DoorDash, American Express. Bloomberg reported it directly. This was the AI SA sell-off, but here's where Bank of America got it exactly right. You cannot simultaneously believe that AI spending is going to collapse and that AI is powerful enough to destroy established software businesses. Those two fears were circulating at the same time, and they are logically inconsistent. If AI spending collapses, AI doesn't get powerful enough to make Salesforce irrelevant. And if AI gets powerful enough to make Salesforce irrelevant, that requires enormous continued investment. The market was pricing in both fears at once, and that is not analysis. That's panic, and panic-driven markets create opportunities for patient investors. There's also a powerful counter-argument to the doom narrative. We consistently underestimate institutional momentum. In 2007, people said the US was geopolitically finished. In 2008, they said the dollar was on the verge of collapse. When ChatGPT launched, they said Google was dead. None of those things happened because institutions with momentum proved far more durable than the doomers expected. Real estate brokers are the perfect example. People have predicted their end for 20 years. All you needed was Zillow and Redfin, and yet the broker is still there, still collecting 5 to 6% on transactions that software could theoretically handle. The iron rule of institutional change: everything is always more complicated and takes longer than you think it will. The number of Americans who work in tech is less than 10% of the total workforce, and software developers are less than 1%. Even if there's a massive reallocation in tech, you can have extreme volatility in the markets while the actual day-to-day economic reality for most Americans changes slowly over years. AI labs together are generating maybe 30 to 40 billion in direct revenues, a fraction of America's overall GDP. We're betting on a future that may absolutely arrive, but the spread between that future and the present we're living in is unusually wide right now, and wide spreads close. So here's the whole picture. A tariff strategy legally invalidated with no durable replacement, and AI narrative triggering a broad sell-off based on internally contradictory fears. A market trading at around 22 times earnings, well above the historical average of 18, meaning it was already expensive before any of this happened. Gold at or near record highs. Gold doesn't produce anything. It doesn't have employees. It just sits there in a vault. And when it goes up, it means smart money is hedging against something going badly wrong. The Federal Reserve having already pumped $90 billion into markets since February just to stabilize things. And a country carrying $38 trillion in debt operating as if the rules of financial gravity have been suspended indefinitely or whatever. So that's the real reason the market's crashing. Not any one headline, but the accumulation of fragility. And if you want to make sure you're positioned correctly for what comes next, head over to stockscommunity.com, where I'm offering a completely free 10-minute training on how I spot stocks before they go up. The same training one of our members watched and went on to make thousands of dollars in a single day. And you can view it 100% free at the link in the description. As always, nothing in this video is financial advice. Do your own research, but let me close by telling you what I think the real opportunity is right now. In an environment like this, tariff uncertainty, AI disruption fears, elevated tech valuations, a Fed backstop telling you exactly how fragile things are, where do you actually want to be? Not in the companies most exposed to the AI disruption story, not in the SaaS platforms being questioned. You want to be where the earnings are durable, where demand doesn't disappear when consumers get nervous, where the pipeline of future revenue is protected by patents, regulatory moats, and the simple biological fact that people get sick and need medicine regardless of what happens to the NASDAQ. When interest rates are high, dividend-paying stocks in healthcare and pharmaceuticals get overlooked because when a treasury bond pays 4 to 5%, you don't need to take a risk to get income. Money flows out of defensive equities and into fixed income. And that rotation's been punishing a category of pharmaceutical companies that have been quietly building extraordinary long-term value. That's where I want to direct your attention. Merck. Merck's trading at a significant discount to the broader market by every reasonable valuation metric. The stock's been beaten up partly because of the patent cliff on Keytruda. It's the company's blockbuster cancer drug, which is real and which the market's priced in aggressively. But what the market is underweighing is the depth of Merck's pipeline, the diversity of its revenue base, and the company's long track record of navigating exactly these kinds of transitions. And as rate expectations shift, which they will as economic weakness becomes more apparent, the rotation back into defensive dividend payers begins. And that rotation is historically very kind to exactly the stock Merck is right now. Out of favor, dividend paying, sitting on a pipeline the market isn't giving it credit for. People do not stop treating cancer because there's a trade war. They do not stop taking their medications because ServiceNow dropped 4%. This is not a trade. This is identifying a company with durable value being underpriced because of temporary macro factors, one that rewards patient investors while you wait for the story to play out. So it's Tuesday. It's 10 after 9. What did I miss? What would you push back on? Let me know in the live comments or the recordings. And if you're managing your portfolio independently and want to know how I spot stocks before they go up, watch my completely free training at stockscommunity.com, where I go over the same methods I teach my students on how to find the best stocks, spending just 10 minutes in front of their computers a day. If you already have a portfolio and want to make sure you're in the right names, download my best 6 stocks to own in 2026 as soon as I get this website sort of working again at free.stockscommunity.com. Of course, that's free. If you found this valuable, smash that like button, subscribe to the channel, and share this with somebody who needs to hear it, because the people who prepare themselves and stay one step ahead will always come out ahead in the long run. Thank you for watching, and